Welcome to Larking Gowen Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Hello, my name's Emma Walker and I'm a tax senior here at Larking Gowen, and today I'm joined by Tony West, who's a financial advisor from Beckett Investment Management Group. Hi Tony, how are you doing?
Hello there guys, doing very well, thank you.
Good stuff. So today we are going to talk about all things savings and investments and how the current economy is changing things in that respect. Anything that we talk about today, any statistics, is going to be correct as at the 30th of June 2023. It's just going to be a general discussion, so there's no formal advice here. But as we'll say later on, if you've got any questions, by all means get in touch with either myself or Tony. So Tony, inflation, how is that impacting everything? What's going on in that respect?
Inflation is very high. It's higher than the Bank of England would like it to be. And the thing is, I think everyone's feeling it in their pockets and in their spending. Inflation is kind of one of those things that it doesn't matter where you are in terms of what your earnings are or anything like that. It is hitting you because everyone's buying food, everyone's paying bills for gas, electric, whatever it may be. Inflation, the May figure for 2023 of inflation was 8.7%. That's much higher than the 2% target. Pre-2023, April 2023, there was only 7 months where we had double-digit inflation. It sort of peaked around 11.1%. The last time we saw that was 1992. So we've had, a lot of people have grown up, taken mortgages out, whatever it may be. They've grown up in this kind of lower inflation environment. And so suddenly we're all looking at it. I look at it with what we spend on our food. Price of pasta is kind of like, it's, with a 6-year-old,
absolutely,
pasta is an essential part of our food shop. And, you see the price of that jumping up. And
absolutely. Well, I'm gluten-free as well, so my food's already expensive, let alone inflation on top. So how is that affecting people's interest on their savings?
So when you get high inflation, there's different ways that it can be dealt with. And the common way for the Bank of England is to increase interest rates. The idea behind this is that if you increase interest rates, then it costs more to borrow money. You're rewarded for having money sitting in your savings account. And so the idea is that then people spend less. And if you've got less activity going on in the economy, then that should bring inflation down. Because it's kind of going back to kind of economics 101, supply and demand. If you haven't essentially got a lot of demand in the system from people buying goods, then people will bring the prices down. The problem with rising interest rates to fight inflation is that it takes time for it to sort of wash out through the figures. The problem with it, though, is that the banks are quite quick, on mortgages particularly, to go put your interest rate up on your mortgage. So, the government are kind of looking at this, and the Bank of England will be looking at it and saying, well, we're not seeing the impact of this in the figures yet, but everyone in the short term is saying, well, I can feel it in my pocket.
And whilst you've said they're quick on rising the mortgage interest rate, sometimes banks aren't quite as quick at increasing the rates on the savings, are they?
That's it, yeah. They do get a lot of stick, and it's been in the media already recently where, newspapers, Money Saving Expert, as a sort of a website particularly, they're quite vocal at sort of, challenging the banks about, well, why aren't you raising your interest rates on your savings as quickly as you are on your mortgages? There isn't necessarily any regulation out there to say how quickly these banks have to put their interest rates up. But you'd like to think with, wonders of technology that people can go out and find decent rates and find that information freely, and so can vote with their money and kind of put it to where they're getting the best interest. So it's not a perfect system, unfortunately.
Absolutely. Well, talking about obviously interest rates and not necessarily having the best rate where you are at the moment, I'm guilty of it. Everybody's guilty of a little bit of customer inertia, not moving about to try and find the best rates. So do you have any information on where people might be able to see the best rates?
Yeah, I mean, to be fair, I mentioned just now, there is websites out there. There's comparison websites. So we always think that there's comparison websites for like your car insurance and your home insurance. There are also comparison sites for your savings as well. So there's quite a few out there. It's quite easy just to jump on Google and type in savings comparisons or something like that, and you can then have a look at different ones. There's quite a lot out there. To give you an idea, though, I mean, I jumped on to Money Saving Expert. I think it's pretty much a go-to for a lot of people when they're thinking of their personal finances. They do a great budgeting spreadsheet on there, which I'm a big fan of. And they have information on there about the best savings rates that they've been able to find. So one of them at the moment is Newcastle Building Society, which is paying 4.3% on a account which has unlimited withdrawals. Okay, that's not at the base rate of 5%, but it's certainly much higher than I've ever seen on sort of savings accounts. Absolutely. I mean, the other one that they had on there was a 90-day notice account, which is paying 5%, and that's with a company called First Save. And again, to have 5% on your savings, that's great. It's a much better return than we've been used to since the credit crunch.
They are huge rates, I have to say, especially I'm certainly used to them being a lot lower myself. And I'm actually seeing this already when preparing people's tax returns. So I'm seeing their interest income having gone up significantly versus last year. And it's not necessarily something that people think about when they're looking at the rates on interest earning accounts, is that you might potentially have an income tax liability. HMRC stopped a few years ago deducting tax at source on interest as a rule. They used to deduct basic rate tax of 20%, whereas now they pay it to you gross. So it's something to bear in mind as these interest rates are increasing, that you might have a tax liability. Depending on what your other earnings are, whether or not you're a basic, higher or additional rate taxpayer, you may have to pay up to 45% tax on the interest that you're earning. So overall, that's massively reducing the sort of net income, if you like, that you're going to get on your interest. So it's certainly something to bear in mind, although there are certain allowances depending on your income. You can get up to £1,000 personal savings allowance, which you aren't taxed on. That's only at 0%.
Yeah. Do you find that people just generally don't really know about those allowances, though?
Potentially, it's more something that people don't realise that they have to pay tax on. I think for so many years, HMRC had been deducting that tax and people hadn't necessarily thought about it. But also because of how much the interest rates have gone up recently, the people who might be in the position where they might have to pay tax haven't ever been in that position before. So they've never really had a reason to think about it necessarily.
Yeah, this is it. And I think we see the same thing when we're speaking to clients. You then start looking at the cash that they have and you're realising, wait a minute, there is more interest coming here, and wait a minute, it's going above a threshold, and suddenly it's, do you know what, you need to speak to an accountant because you've got something here to declare. And yeah, it's, it really does feel like it's a very different world now because of inflation and interest rates than what we've been used to, certainly, since 2021 kind of onwards almost.
And there's some taxpayers that will be impacted even more. Those who are on the verge of being a different rate taxpayer, even if the interest is falling within that personal savings allowance, it's still income. So it's going to tip you potentially into either paying the high income child benefit charge if you're on the verge of earning £50,000 or more, or potentially abating your personal allowance if you're earning around the £100,000 mark as well. So there's lots of things to think about, and it's certainly increasing tax bills from what I can see just looking at the 2022-23 tax returns.
Yeah, and I guess that's going to carry on, isn't it?
Absolutely, yeah. Obviously, because interest rates are still really high and by the looks of things increasing, we're probably going to see this for certainly a couple of tax years to come. So it's certainly something to think about for individuals who've got money in savings account. Do I need to pay some tax on this interest?
Well, yeah, that's it. And there's plenty of reliefs. There's different, things like ISAs, particularly, are sort of one of the most popular products that I think you can find in the UK. And, if you can earn a rate of interest and then have it in an ISA where you don't have tax taken off that, then that's great. And at least that way you're then saving the complication of doing a tax return and reporting that, but then you're actually keeping more of your return for your benefit at the same time.
Yeah, so with ISAs, whether that be stocks and shares or cash only, they are exempt from tax. So they don't come into your tax return at all. There are limits per year. Tony, I wonder if you might be able to shed a bit of light on that just so people are aware.
Yeah, so essentially with, as Emma said, you've got sort of cash ISAs and stocks and shares ISAs. You've got £20,000 a year that you can pay into an ISA. How you split that £20,000 between the two different types is entirely up to you. So you could do £10,000 into a cash ISA and do £10,000 into a stocks and shares ISA. As long as the total into the two doesn't go above 20,000, you're fine. But one thing you can't do is that you can't do two of the same type of ISA. So, for example, you couldn't do £10,000 into a cash ISA, for example, with provider A, and then do another £10,000 cash ISA with provider B. That would break the rules. But yeah, £20,000 is not a small amount of money. And if you do it over a period of years, there's quite a number of people out there that are ISA millionaires because they've gone and invested this money. They've done it over, over decades of using these ISA allowances as they've changed. And yeah, they're sitting on £1 million of, tax-free returns, which is fantastic. Yeah,
fantastic.
Yeah. Unfortunately, it's not my position. Hasten to add. Yeah.
If only, that's the dream.
Yeah.
So there's other types of ISAs as well, isn't there? Because the LISAs are quite popular as well with new home loans, or trying to be new home
Absolutely,
loans.
yeah. So you've got LISAs, and you've also got junior ISAs or JISAs as we call them. We love shortening these names. When you're looking at things like a LISA, you can pay £4,000 into that. The government will give you a 25% bonus, so they'll take it up to £5,000, per tax year on this. Obviously, the less you invest, the less the monetary amount of the bonus is going to be, but it's always going to be 25% of what you pay in. But they're great. You have to be over 18 before you can open one, and essentially the withdrawal kind of criteria on this is that it's used for a deposit. For a first-time buyer, or that you access it after age 60. So the idea is that you're then using it as something to fund your retirement.
So are there any other investment opportunities that might be worthwhile looking at from trying to reduce a little bit of tax?
The big one is that you'd expect a financial advisor to talk about is pensions. That absolutely is kind of one of the big tools that we have at our disposal. And the reason being is because pensions are meant to be tax neutral. There are lots of different allowances that you have to be mindful of, particularly the annual allowance. So it's like the ISA allowance. I don't know if they call it the annual allowance, but like how you have your ISA allowance limit of 20,000 on pensions, you're limited by 60,000 in the current tax year.
And that's only just gone up, hasn't it?
It has, yeah, from 40,000. So that was a bit of a gift from the Chancellor in the budget. And 20,000 extra on the 40, so giving you 60,000 you can pay into your pension each year is a big number. Hasten to say that is gross, so that's with your tax relief added on there. But the nice thing with pensions is that you can actually backdate that to include the previous 3 years as well. So you essentially could have 60 for this year and then 3 lots of 40 if assuming you hadn't made any other pension contributions in that time. So you can get quite a significant amount of cash into pensions. It does depend on what your earnings are as well. So the idea with pensions being tax neutral is that if you're a 20% taxpayer and you were to pay £100 into your pension, you'll get an extra £25 added onto it. If you're a higher rate taxpayer, then you'll get that £25 added on if the pension scheme does it at source. And then that 125, what we call gross contribution, you can actually put on your tax return and it will increase your basic rate of tax. So you'll get an additional 20% there, and that's why it becomes tax neutral. But like an ISA, as the money grows in the pension, it doesn't attract tax. It's just when you then take it out, you have to be mindful of what you're drawing and whether or not it falls under income tax. But yeah, pensions are absolutely there. ISAs definitely. And then really kind of, I think from, not that we have a checklist for each client, but you kind of, in your head, you're sort of ticking off these kind of important tax efficient products. But beyond that, you then have sort of general investment accounts with providers. And you also have investment bonds. They again are quite common investments that we see for sort of people on the high street, if you like. You don't necessarily have to be a sophisticated investor to have those. But the great thing with general investment accounts is that depending on what you're invested into, the growth you get on that is then set against capital gains tax. So it doesn't actually come onto your income tax calculation necessarily. And that's one that I think a lot of people are guilty of not utilising is their capital gains tax allowance. But I mean, you probably see that.
Yeah, so I think we're going to see more capital gains tax being paid going forward, because the Chancellor announced that the capital gains tax annual exemption, which is like your personal allowance, has been reduced. So it was £12,300 last tax year. This tax year it's £6,000, and then next tax year, which is 2024-25, that's going to be down to £3,000. But it's still definitely a good exemption to be able to use for tax purposes. And capital gains tax at the moment is certainly a lot lower in terms of the percentages of tax that's being charged versus income tax. So that's certainly an attractive idea for investments, certainly, to try and reduce that tax bill. And just going back to pensions as well, I mean, they are brilliant for saving some tax. I know it's a bit of a misconception, certainly. I've had the argument in my own family that people seem to think that you're taxed twice. So you're taxed when you put it in, and then you're taxed when you're taking it out. But that's not the case. Like Tony said, you can get some really good tax relief when you're putting the money into the pension. So then you can save for a lovely retirement.
I get this when I go and speak to my hairdresser. Bless her, I remember speaking to her a few years ago, and I'm telling her about what I do, and as my job has changed over the years, and she said, well, I don't really believe in pensions, I think they're rubbish. And I was like, oh, right, okay, well, why is that? Well, it doesn't really grow. I was like, well, then the problem isn't necessarily with the pension. All a pension is, same as an ISA, it's just a product wrapper, and it's a way of controlling the investment that you put within it, but it's the investment, it's the engine you put inside it that makes it go up or down in value, and that's whether or not it's good or your perception of whether or not it's good or bad. Pensions, like I say, they're just a tax wrapper, and if you can use it for the benefits, then fantastic. You just need to make sure that what you're putting inside it is actually doing a decent job, and that's a hard job to do. So using a financial advisor is a great way to make sure that that investment is doing what it needs to do and is being monitored and maintained in the right way.
Absolutely. And there's also the matter of employer contributions as well for pensions. So any owner-managers for businesses that might be listening, if you've got a limited company, you could consider making some contributions from the company.
Yeah, absolutely. I mean, that should be, if you're running a business, that should be part of kind of like your annual sort of checkup, if you like, of thinking, right, have I got profit in this business? Is it, can I make a contribution to a pension? Obviously it's got to be attributable to that business and to what you're doing for the business. But if you can, fantastic. It's a great way of kind of building up a bit of insurance to your exit strategy. So whether or not you're, selling the business in decades in the future, or whether or not, you've got a management buyout, or, all these different things people can do to get out of their business and get the value out. If you've then gone and chucked away your £60,000 a year into a pension, and you do that over 10 years, well, fantastic. There's £600,000 that you've tucked away, and that's a bit of insurance in case your business doesn't sell when you want it to, or it doesn't get the value you want it to. It's just having that diversification, and exactly this is it. And, not having all your eggs in one basket, which is, time old saying.
And talking about eggs in one basket, VCTs, they are another investment potential opportunity out there. I don't know if you want to have a little chat about what that entails.
Yeah, so VCTs, I find VCTs quite exciting. That kind of caveat on that is that my risk profile, if you were to score it out of 10, it's probably a 12. I'm in my mid-30s. I've got a long time until I retire, so I feel I can afford to take risk. VCTs, they are very good in that they have certain tax breaks, which I'll let you sort of touch on, Emma, but not to steal your thunder, obviously. But the great thing with VCTs is that you're investing into smaller companies in the economy, and so when you do that, the government's willing to kind of give you something back for doing that, because it saves them having to do it at a central level. The good thing with VCTs is that there's a large range of providers that are out there. So there's plenty of choice. You can look at what is ultimately being invested into. So you get what's called generalist VCTs, so they'll invest across different sectors of business. Or you can get specialist VCTs, so they might particularly focus, for example, on tech companies. With a VCT, you generally tend to find that your return is from the dividend that this generates, rather than from the value of it necessarily rocketing up in value. But when you get these dividends, they're tax-free, and you can then use that to reinvest into subsequent years to fund the next VCT. And so one of the things we tend to do a lot with clients is that we look at this kind of conveyor belt approach. So once you've held a VCT for 5 years, you've met the qualifying sort of criteria, the period of time you've got to hold it for to get all the tax reliefs. And then when that matures in year 6, you can take those proceeds and you can then reinvest it and start your year 6 contribution by almost recycling it in a way. So yeah, fantastic. But, from a tax perspective, probably something that gives you a few sort of different levers to pull there.
Absolutely, yeah. So the top highlight, I would say, from a VCT perspective, is you can get up to 30% of what you invest back as an income tax reducer. That is an up to. There is a maximum. It's quite high. It's £200,000 that you can invest per tax year, and it can only reduce your tax liability down to nil. So you can't get a refund out of it effectively. So bear that in mind if you're thinking about investing in VCTs. You're quite right. The dividends, they're tax-free on the shares, if you like, or the investment that you've made. Up to £200,000, that ceiling again per tax year. So if you're putting any more in, then the dividends are taxable as normal. But certainly the vast majority of them, I'd say, for the vast majority of people who are investing in VCTs, are certainly going to be tax-free, which is great. They don't need to go onto your return at all, so they don't count as income towards any high income child benefit charge or personal allowance abatement, which is really handy for those higher earners.
Yeah, definitely. And like I said, VCTs aren't necessarily if we're picturing the financial advisor's checklist of products, they definitely won't be one of the top ones. We'd want to look at things like ISAs, pensions, and even other things like investment bonds and general investment accounts first. But where it's right and the risk profile is right for the client, because these VCTs, they are definitely on the high end of the risk spectrum. So when we're looking at them for clients, we have to look and say, well, can this person afford for this to not perform? Because there's a higher chance that might be the case with these. But you're getting this payoff in the tax reliefs as well. So when you look at it in the round, they're absolutely on the considerations. And when you earn a lot of money, then and you've sort of reached the limit what you can do on your pension, then again it's another option there. The 5-year period that you have to hold it on to get those tax reliefs, that isn't necessarily an issue if you're using it as part of your retirement plan, because that's going to be over the long term anyway.
Absolutely. So the one thing to say about that 5 years is if you do need to take the money out within those 5 years, they will claw back that 30% tax reducer. So it's certainly something that if you're going to invest in, you want to make sure that you're definitely not going to have to touch that money for the 5-year period.
No one likes a tax demand from HMRC.
No, that's it.
Yeah.
So yeah, that is just one thing to bear in mind, and they will look back to the year that it was invested in to get that money back. So that is just one thing to consider on that point.
Yes. So I mean, one thing probably worth touching on, Emma, is we talked about savings and interest rates, but equally, a rise of inflation has had a bit of an impact on markets. And we're having conversations with clients at the moment where they're saying, well, look, I can get 5% or whatever it may be on my cash, but hey, my investment portfolio has gone and dropped 9-10%. So when you look at it like that, you sort of think, well, yeah, 5%. If you're getting that interest, you take away the inflation, you're still not making a real return. And if you've gone and lost 9 or 10%, well, that's only made the problem bigger. The problem with that school of thought is that when you when you're looking at the performance of an investment, and it is, say, for example, down 10%, that is on paper. So as long as you're in a position where you don't need to actually take that money out and you can leave it invested, then you have every chance, depending on the investment, but you have every chance of that being able to make a recovery. And it's when you look at the long term of investment returns over cash, that's where you start to see the argument of saying, well, no, you need to consider having a diversified position using a mix of cash and riskier investments so that you can try and attract those higher returns and beat inflation over the long run.
Absolutely. I have to say, looking back to the COVID days, I had a pension annual report posted to me April time, I think, of 2020. You can quite imagine the look on my face when it turned up that the markets had crashed down, but obviously at the end of the day, a pension is long-term planning, like you quite rightly say. So sometimes it's a bit of a panic to look at immediately, but
definitely. I mean, 2020 is a really good example. So you had, for example, over a period of 3 weeks, you had in stock markets globally fallen through the floor. They didn't necessarily actually fall by as much as what they did during the credit crunch, but they did it in such a short period of time over that 3-week period, whereas over the credit crunch, it took about 18 months or so for markets to kind of reach their bottom. So it was it wasn't necessarily deeper, but it was a lot quicker, and that is absolutely scary for everyone involved. Don't think financial advisors are sitting here, saying, "Oh, we're not worried about it." We're our hearts skip a beat as well because we're mindful of that it's other people's money that we're looking after and helping advise on. But 2020 is a good example because when you get through to the end of the year, markets have generally recovered, and as long as people hadn't panicked and sold out at the bottom of the markets, which was towards the end of March in 2020, as long as you held out by the end of the year, you were able to actually make a positive return. And that's a really strong lesson. And I think what we're going to see going on now is that markets have struggled. They will come back in future. You just need to have that bit of time and have that bit of patience. Easier said than done, but as long as you can hold the nerve, then it, longer term, this stuff tends to work more in your favour.
Gotta have faith, eh?
Absolutely, yeah, definitely. I mean, there's loads of statistics I could chuck at you about this time, about this, the different returns and so on and so forth. But I mean, one thing that Schroders have produced is just something that I think, rather than giving you average returns and all this stuff, because it's all sort of depends what period you look at for an average and so on and so forth. But essentially, Schroders looked back from 1926 to 2022. So taking into account high inflation, and they were looking and saying, well, what percentage of time would you have found large cap stocks outperforming cash? And where you did this looked at it over a 10-year period. So this is any 10-year period from 1926 through to 2022. So quite a long period of time. 10-year period, you tend to find that large cap stocks, 87% of the time would beat inflation. Cash only did it about 55% of the time. So it's not impossible for cash to outperform inflation, but it just doesn't necessarily do it as regularly as the stock market might. When you looked at it over 20 years, the large cap stocks had actually beaten inflation 100% of the time, and cash was 66% of the time. I mean, past performance and all that, it's not a guarantee to future returns. Got to add that in there. but it just shows the value of investing for the long term. And if you're doing it in things like your ISAs and pensions and so on and so forth, then fantastic, you're doing what you can to fight inflation.
So history shows that long-term investments are probably best to fight off inflation in the long run.
Absolutely, yeah. I mean, you've got to hold cash in the short term. Everyone does. We keep a certain amount of cash back for emergencies. Now, the textbook says that it should be minimum 6 months outgoings. We have about 12 months outgoings. That's what I feel comfortable with. It's not right or wrong. It's just what I feel safe with. So we've got that in cash. And okay, that's going to be eaten away by inflation over a period of time. But my pension and the money that I don't need to touch in the short term is tucked away. It's working harder. It's taking some risk. I had a pretty awful year on my investments last year. I'm not worried about it. Adding to them because they're cheap right now, and letting them, recover in due course.
Well, Tony, we've talked about a lot today. Thank you so much for joining me.
Thanks for having me, and giving me a chance to sort of share my knowledge and what we're seeing at the moment. If any of the listeners want to reach out and get some financial advice from us at Becketts, they certainly can do. Head to the website, it's beckettinvest.com. Yeah, more than happy to help, and we're happy to have sort of free initial consultations with people to sort of see where we can add value.
Fantastic. And likewise, if anybody would like to get in touch with us at Larking Gowen regarding any tax implications of anything that we've spoken about today, then you can visit our website and get in touch. All links will be in the show notes. Thank you so much for listening.
Thank you for joining us for Larking Gowen Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larking-gowen.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.